Hello everyone and welcome to your first video on group statements. You'll see that in this video we are going to focus on chapter 1 and chapter 2 of your group statements textbook. You'll also see that there are many standards that is applicable when we do group statements. IFRS 10, IFRS 12, IAS 27, IFRS 3. Luckily, we won't necessarily be doing all of them today or at the same time. But for now, today in this video, we will focus on chapter 1 and 2 of your textbook. You will see on Ifundi, there's a whole list of learning outcomes that we should have achieved after completing group statements as a whole. But for today, focusing on chapter 1, you'll see it's introductory just to gain an understanding of what group statements are, some of the basic calculations, and maybe some of the consolidation procedures. After completing chapter 2, there's a few definitions that you will have gain an understanding on, as well as an understanding of what you use as the amount of consideration. And then obviously from there on being able to calculate goodwill and your gain on a bargain purchase. Now, before we start to fall into a lot of the details that we need to look at, let's just try and understand what group statements are all about. So you have a company, company A, and another company, company B. Now, company A decides to buy company B, but in doing so, instead of buying their assets and their liabilities from them, they buy their share capital from them, making them now the owners of company B, and therefore they purchased company B. Now, when we work with group statements, it's very important that this purchase transaction that we just talked about causes A to gain control over company B. The moment that control is established between company A and company B, meaning company A controls company B, that control triggers a new economic entity to come into existence. So A and B become one new group of entities, so a third. So you have entity A, entity B, and then you have this new entity called the group. Because you created a third entity, it now means that this third entity also has to prepare group financial statements, and we call those financial statements consolidated financial statements. That brings us to our first standard that we have to look at, IFRS 10. Now, there are two main things that you will learn from IFRS 10. Number one is what is control. Now, from our perspective, that is very important because only when control is established do we create consolidated financial statements. And then secondly, IFRS 10 will tell you when control is then applicable and you have to consolidate, what are the consolidation procedures? How do you consolidate your group financial statements? We can make use of a diagram to lay out what control means. So for us to control an entity, three things need to be in place. I have to have power over this entity. I must also be exposed to variable returns from this entity. That's something like a dividend. And then very important, there must be a link between the power I have and the returns I get. So I must have power to influence the returns that I get from the entity. And then I control the entity. Take note that nowhere in this definition, we'll look at the detail in a moment, but nowhere ownership is needed for us to control. The definition that IFRS 10 gives us of what control is, it states that an investor controls an investee if the investor has the following. So the investor is the company that purchases the shares in the other company. So the investor has to have the following three things: exposure to or rights to variable returns from their involvement with the investee, and power over the investee, and the ability to use this power over the investee to affect the amount of the investor's returns. For the purposes of accounting 2, we will not ask you to discuss whether you have control over another entity or not. But for our purposes, it is very important that you are able to identify that ownership on its own is not necessarily a requirement before you control another entity. Now you'll see your textbook goes into quite a bit of detail on each of these three elements that needs to be there for you to have control. So let's just touch on a few of them. And the first one is that you have to have power over the other entity. So power is the existing right that you have. It must exist now already. And it should give you the current ability to direct the relevant activities of the investee. And you would normally get this ability via voting rights. And the voting rights is you're usually allocated based on the number of shares that you have. So normally each share has one voting right attached to it. Now, you don't necessarily have to own shares before you have voting rights. So there can be other ways you get voting rights as well. And we'll look at them in a little bit. If we look at what the Companies Act regards as control, they will talk about you having the ability to exercise the majority of the voting rights or have control over the exercise thereof, or secondly, to have the right to appoint or choose the directors of the company or the directors that have the majority of the voting rights. And then the third option is when you control the people who control the above two items. So all the general voting rights of the issued securities of the company is held by or controlled by persons mentioned above. So if a company controls another company, which controls another company, then the one at the top technically also controls both other ones because they can control the middleman. Alternatively, if you can control the person who controls appointing the directors, or the majority of the directors, then you also have control over the company without owning any shares even in the company. From that, it therefore follows, and I think you've noticed it by now, that a parent company does not necessarily have to own shares or all the shares of a company, because ownership is not necessary to create a subsidiary relationship. A subsidiary relationship is created the moment you control the subsidiary, which can happen now in various different ways. For further background information about what control entails, you can read from page 10 on your group statements textbooks or group statement textbook on the other elements and the detail that makes up control. Okay, so voting rights is normally something that could give control from one entity to another. And we said voting rights, for each issued share, you have one voting right, except if it's otherwise specified in the Companies Act itself or in the Memorandum of Incorporation of this company. A company A Limited has 45% or owns 45% of the equity shares of B Limited. There are only two other investors or owners of shares of B Limited, and one of those owns 30% of the shares and the other one owns 25% of the shares. What do you think? Does A control company B? Okay, so hopefully you could see that even though A owns the majority of the shares, it doesn't mean they control company B. If the other two shareholders together decide to vote in a certain direction, that makes up 55% of the vote in total. Therefore, A will never be able to control B, and control is therefore not applicable in this case. For more examples like this, please carefully work through each of the examples listed in your textbook, starting from example 1.1 all the way to example 1.8. The potential voting rights that you have could also influence whether you control a company or not. The only thing to watch out for with potential voting rights is that you have to have the practical ability to exercise that right. So there shouldn't be anything standing in your way to exercise your potential voting right meaning that the potential voting right becomes an actual voting right, and together with your existing voting right, that can then potentially give you control over the company. So in this example, A Limited has 70% of the ordinary shares of B Limited, and X only holds 30% in B Limited, but X has an option to acquire half of A's shares, so half of the shares that A owns in B. That gives us 45%. So if X did exercise that option, they would have their 30% plus the 45% options, which means that then they control the business instead of A. However, at the end of the question, it says it's not certain that the option will be exercised. So um, assuming that that then means that X probably does not have the practical ability to exercise the right, and therefore in that case A still has control over B. The second element of the definition of control, remember that is again the exposure to or rights to variable returns from this company. So the variable return could be anything from dividends that you receive or interest or another form of remuneration. So it can be any form of a return as long as it's a variable return. And then the third element that you'll remember that's very important is there must be a link between your returns, these variable returns, and the power you have. So you have to have the ability to use your power to affect these returns. Some definitions that might be worth mentioning to make sure that we're all on the same page and referring to the same thing. When I talk about a group of companies, I mean the parent company and its subsidiaries, so the little ones. And the subsidiary is then the entity that is controlled by another entity, which we call the parent. So the parent is the one in control, and the subsidiary is the one that the parent controls. Then the last one here is a business combination, which is a transaction or other event where the acquirer obtains control of one or more businesses. Now, this is important because we usually only have group statements when we've identified that there is a business combination. The first type of group that we get is called a simple group, and it's just that. It is the simplest type of a group. It's where you have your parent company, and your textbook would refer to that with a P, which controls its subsidiary, which is the S that your textbook will refer to. So a simple group is just the parent company that controls a subsidiary. Then you also get a complex group where in this case you have a parent company. It's a horizontal and a vertical group. So you have your parent company that owns or controls rather 3 subsidiaries in this case. So those 3 subsidiaries are horizontal, but one of the subsidiaries also controls yet its own subsidiary, therefore it's vertical. So in this case, then it's your parent with its 3 subsidiaries, and one of the subsidiaries also has a subsidiary, makes it a complex group. We also get what we call a vertical group where the line just goes down. So you have your parent company, which controls a subsidiary, and that subsidiary controls another subsidiary. That then brings us to the consolidation process. And the first thing that we probably need to know about consolidation is when must we start with the consolidation procedures. So consolidation starts, and it's fairly easy. It starts on the date that you obtain control over an investee. And it stops on the day when you lose control over that investee. There are some exceptions as to when you do not have to prepare group financial statements and therefore not have to consolidate your financial statements, but all 4 the following requirements have to be met before you can make that decision. So you, the parent company, have to decide whether you have to consolidate now, but you as the parent company is also a subsidiary of another parent company. So you're sort of sitting at the middle. You are yourself a parent company, but you also have a parent company. So if that's the case, and the owners of this company were all informed that you do not want to prepare group statements and they agree to it, then you have a go. But what must also then be true is your debt and equity instruments may not be traded publicly, which means you cannot be listed on the JSE. And you also could not have applied to be listed on the JSE. and your ultimate parent, or the intermediate one, the one just above you, or the ultimate high top one of those also is going to anyway prepare group financial statements or consolidated financial statements. Therefore, you would then not have to. The consolidation procedure can basically be divided into 3 steps. The first step is to combine all the financial statements of all the companies in this group together until you've added them all up together. So you combine all the financial statements of the companies in the group. The second step would then be to eliminate the like items. So we'll talk about that in a little bit more detail just now. Then the third step is to eliminate your intergroup transactions. So the transactions that the companies in this group had with each other. If we look at the consolidation procedures in a little bit more detail, we said that the first step was to combine your financial statements. So you'll take all the financial statements of all the companies in the group, and for each line item in your balance sheet and your income statement, you add them together line by line, the assets and liabilities, you add them line by line until you've done all of those. Then the next step we said was to combine or to eliminate the items that are the same. Now in this case, if the parent company bought an investment in the subsidiary, they would have purchased the subsidiary shares. So in the parent company, they have this investment, but this investment is in the subsidiary's shares. So now if you create a new set of financial statements for the group, you can't have an investment in yourself. So on the one hand, you have the asset of the investment, and on the other hand, you have the equity that you invested in. So you cannot keep both, because you cannot have an investment in yourself and own your own shares. And that's why we have to eliminate that part. Then the third step we said was to eliminate your intergroup balances and transactions. Now you can't have a transaction with yourself. As a group, you become a new entity. So if A sells to B, or B purchases from A, you can't show in your group statements that you made an income or profit on that sale, because you sold it to yourself. Therefore, you have to eliminate it because for the group's point of view, it doesn't exist. And then lastly, what I want to mention here is to be able to do the consolidation procedures, we are going to make use of journal entries that have a special name. Now we call it pro forma journal entries, and they're called pro formas because they're specifically written to prepare group financial statements. These pro forma journal entries are not written into anyone's books specifically or processed into any of the company's books. You can almost see it like a work paper you prepare full of journals to help you to consolidate the group's financial statements. That means every year when you consolidate, you have to rewrite all your pro forma journal entries because it would have disappeared since it was not taken up into any of the companies that you're consolidating's own books. Therefore, every year you have to re-prepare a working paper in order for you to be able to create your group financial statements. Let's see if we are able to practically apply these consolidation procedures. If I give you just a basic trial balance or basic statement of financial position, you'll see I'm listing items of property, plant, and equipment, the investment in S, your current assets, your equity, and your current liabilities. And I list them for P and for S, so for the parent and for the subsidiary. So obviously from these sets of financial statements, I can already see they said it's 100% subsidiary. It means P owns all the shares in S. So you can see that line called investment in S in P's books is probably the investment that they have in S then. And then you'll see that the equity in S is equal to that exact same 40, meaning the investment in S is an asset in P's books, but it's equity in S's books. Then from here on we start, and the first step was just to combine everything. So we have to add all the assets and liabilities line by line. So I add up the PPE, and the group's PPE is therefore 150. The Next asset I have is current assets, and in total that gives me 30. You would have seen that I skipped the line item for investment in S first. It's also an asset, but I skipped it first. But we skipped it because we know that that is an item that we're going to have to eliminate against the equity because it represents the same thing. So the investment in S in P's books is 40 Rand as an asset. But the asset is the equity in S's books. So in S's books, it's just represented by equity. And in the group's books, you cannot have an investment in yourself. So this investment cancels out against the equity because the group cannot invest in itself. Therefore, in the group financial statements, your investment in S should be 0. You cannot show that the group has an investment in S because technically they then have an investment in themselves. But for the new entity, it's not possible. And that investment is cancelled out against the equity that you have the investment in, which is in S's books. So that means the 40 asset in P's books cancels out against the 40 equity in S's books. And then the total equity of the group is only represented by P's 100 because you can't show that you have 100 plus 40 because the 40 is represented by the investment that you have in yourself. So your group equity is only equal to P's, the parent company's 100. And lastly, we just add together the current liabilities to give us a total of 80. I will come back to the rest of the detailed consolidation procedures. I just wanted for now to give you a feel and show you what it is that we do when we consolidate financial statements. So we will get back to that later. Just a few other things about consolidation that you need to know. The parent and subsidiary obviously have to have the same reporting date, hey? Otherwise, you're going to try and compare apples and pears with each other. So if the subsidiary is not preparing financial statements with the same date as the parent company, then the subsidiary is going to have to redo their financial statements and prepare proper ones with the same reporting period. Unless it's not possible for them, but there must be a really good reason why it's not possible, then you can maybe only adjust the significant items and then consolidate it. The second thing would then be also uniform accounting policies. It can't be that the one uses the revaluation model and the other one the cost model. Again, you'll be comparing apples and pears, which we can't do. So the subsidiary should prepare financial statements with the same accounting policy as the parent company. And then the same would apply if it's not possible for the subsidiary to prepare those. The same approach would apply as with the previous one, as mentioned. Let's quickly talk about your separate financial statements. So separate financial statements are governed by IAS 27. So when I talk about separate financial statements, I mean the financial statements of the parent company itself. So before it prepared any group statements, its own financial statements, those are your separate financial statements. Now these statements, it's in other words the statements of P, they will contain that line item called investment in the subsidiary. So you would have purchased the investment in the subsidiary and it's shown in these separate financial statements. Now you need to decide how to measure this investment. It's an asset. So just like you would have decided how to measure property, plant and equipment, either at the cost model or the revaluation model, you still have to do the same thing for an investment in subsidiary. Now, this investment is actually a financial instrument. Financial instruments are not within the scope of accounting 2. However, in terms of group statements, you do need to have a little bit of knowledge about this financial instrument. So here's everything that you need to know. I'm going to discuss it now. This is the only thing you need to know. When you decide to measure your investment in the subsidiary, you can choose to either measure it at its cost price or what I'm going to refer to in short, IFRS 9. So you make a decision. Are you going to carry it at cost or in terms of IFRS 9? If you carry it in terms of IFRS 9, you have a choice of how to carry it. You can either carry it at the fair value of that asset, but any fair value movements that then happen have to go to profit or loss, just like we would have done with investment property. The alternative is to choose to carry it at fair value, but the fair value movements go to other comprehensive income. Now, it's your accounting policy that's going to determine which one you have to use, but the guideline for deciding on your accounting policy will be your business model. So normally when your business model is to obtain other entities for long-term growth and for synergy purposes, for expanding your business, then you would probably elect the fair value through other comprehensive income. If you purchased the shares because you want to sell it at a profit, quick turnover, so your purpose was not long-term growth but just to sell the share at a profit, then you'd probably pick fair value through profit or loss. But for group statements purposes, the way we do it when we prepare group statements, it means you probably purchased the shares not for financial gain in selling it, but rather in expanding your business. Therefore, when we see groups or do group statements, you'll see in your textbook, we all the time are going to use, if we elect IFRS 9, fair value through other comprehensive income, because it's because of long-term growth and not profit making. You can look in your textbook example 1.9 to 1.11, where there are a few journal entries to help you see what happens when you write these journal entries. I will do more examples on this and explain this in a little bit more detail later on. For now, this is what you need to know. Okay, so that was chapter 1 in a nutshell. Just a quick recap. What are the most important things that we saw from chapter 1? We learned about control and control versus owning shares and voting rights, and that control is the thing that causes us to then start to consolidate. And we also, in just a quick view, looked at how we do consolidation procedures. Guys, chapter 2 is a little bit more theoretical, but there are a few things that we need to look at here, including the guidelines of how to do specific calculations. So luckily for us, we don't have to do everything in chapter 2. You'll see in a little bit, I'll tell you where you can stop. Chapter 2 is based on IFRS 3, which basically tells us how to measure assets and calculate goodwill, etc. We'll talk about that in a moment. So the three main things that we get from IFRS 3 is it helps us to identify if we have a business combination. So remember we said business combinations triggers group statements if you have control. So it has to be a business combination and you have control, then you consolidate. Then it helps you to measure your identifiable assets and liabilities in order to consolidate. So what amount to use to measure it at. And lastly, it helps you calculate your goodwill. And if you did not calculate, measure, and account for goodwill, and if you did not have any goodwill, and maybe a gain on a bargain purchase is applicable, then it helps you to measure and calculate that. Okay, so a business combination is a transaction or some other type of event where you have two parties, an acquirer and an acquiree. So the acquirer obtains control over the business of the acquiree, and he gets this control in exchange for the transfer of some form of consideration, either cash or another form of payment for him to obtain control. You can read through the definition of a business on your own. I'm sure you don't need me for that. IFRS 3 describes what is called the acquisition method. In this method, there are 4 steps that you need to follow to acquire or to account for the acquisition of an entity. Step 1 is to first identify the one who is acquiring, so the acquirer. What is the acquisition date? And then to start recognizing your assets and liabilities, and then the non-controlling interest if you did not buy 100% of the equity of the company. And the last step is then to recognize the goodwill. On this slide, you'll see it's just a different representation of what we just discussed about the acquisition method. For the purposes of accounting 2, you don't need to know more about step 1, the identification of the acquirer, other than that it is the party that obtains control. So that's all you need to know about step 1. The acquisition date will always be the date on which you obtain control of a company. And you can look in your textbook example 2.5 for a small example of that happening. When we look at the recognition and measurement of the assets and liabilities that we acquired in the business combination, we're going to just have a look at the normal definitions of an asset and a liability as per the framework. And then obviously the assets and liabilities should form part of the exchange transaction or the business combination when you just got this company's business, including its assets and liabilities. And then it might be worth noting that according to IFRS 3's rules, it could lead to the recognition of assets and liabilities in the books of your group financial statements that you would not have necessarily been able to recognize in the company's own financial statements. And then lastly, very important for us to remember, when we bring in the assets and liabilities on consolidation into our books, we have to measure those assets and liabilities at its fair value at the acquisition date. The final step is then the recognition of your goodwill. Now you'll see I've listed the definition of goodwill here for you, but it might make more sense to you if I rather just try and explain it to you. So after you've purchased the assets and liabilities of this company, because you purchased the company, you bring in the assets and the liabilities. So that's called the net asset value. So your net asset value is the difference between your assets and your liabilities. So assets less liabilities is your net asset value. So that's the value of what you purchased. Now, if you compare that to the amount of consideration you paid to obtain this business, and you then paid more than the value of the net asset value, that amount that's higher is called goodwill. It's an asset because you paid a little bit more for something that you can't necessarily specifically see or identify yet. In a moment, I'll show you how to calculate it, and I'll also quickly mention what happens if you paid less for it. You might not understand the formula for calculating goodwill 100% just yet, but we will slowly but surely work our way up to understanding the formula 100%. So for now, what I want you to do is please to memorize this formula. And goodwill is calculated by saying the value of the consideration I paid at the acquisition date plus the non-controlling interest at acquisition date's value minus your net assets at acquisition date. Now remember we said net assets is assets less liabilities. And another name for that could also be equity. Hey? So that would give you goodwill. If you paid more for what it is worth, then you have an asset called goodwill. If you ended up paying less than what the company was worth, meaning this formula is going to give you a negative answer, we call that a gain on a bargain purchase because you purchased it for cheaper than what it actually is worth. So a gain on a bargain purchase is a profit or loss account that closes off to retained earnings like any other profit or loss that you make. At this point, I have great news for you. And for chapter 2, you can stop just before example 2.9. The rest of chapter 2 is not part of our syllabus. Okay, everyone, that summarizes chapter 1 and chapter 2 of your group statements textbook. So you'll see it's very theoretic. It was designed to just give you an introduction to group statements. From here on forward, we'll get a little bit more practical with calculations and journal entries and presentation.